Most people think getting into real estate requires a huge bank account or a long background in real estate. That wasn't true for us. You guys, when we started, Haley and I were working professionals with full time jobs. We had savings, but nothing extreme, and absolutely no real estate experience. When we first decided to invest, we did what a lot of people do. We looked at everything, and we saw potential in everything: single family homes, condos, apartment buildings. We even explored mobile home parks, many properties that sounded good but made no sense for where we were in life. We spent months confused, frustrated, and unsure what we were even looking for. It was then that we realized we needed to deepen our thinking and understanding of real estate. So we spent time and money to learn. We invested in our ability to invest in real estate. And this process eventually led us to buying our 6 unit property in Miami. Today, I want to walk you through the 4 steps that helped us go from feeling lost to confidently buying that first property. And by the end of this video, you'll know how to quickly tell whether a deal actually works for someone with a full time job. And just as important, how to rule out deals that look good online but don't work in real life. So let's dive in. All right, you guys, step one: financing comes first. Before you look at properties, you need to know exactly how much you can afford. When we started, we didn't do this. We guessed, we assumed, we hoped the numbers would work. And that caused us to look at properties we were never going to buy, which ultimately wasted time. Not just for us, but the real estate agents as well. The fix was super simple. We talked to a lender and got pre-approved for financing. And that pre-approval told us our exact price range and the different loan products that were available to us. There were 3 loan types we were presented with, depending on the property type. And the first was the FHA loan, which required 3.5% down payment and needed to be used for a 1 to 4 unit property. The second and third were the conventional loan and the DSCR loan, which required somewhere between 15 and 30% down. Now, the lowest down payment option sounded good initially, but after doing more research, we quickly learned that it hurt our cash flow. The cash flow being the money left after rents came in and expenses went out. Yes, you're paying less money up front, but that results in a higher mortgage payment. And with that higher mortgage payment, we found it very hard for the rental income to be higher than the monthly mortgage payment and the expenses. Let me give you an example. Let's say you buy a $400,000 property with a 3.5% down FHA loan. Your mortgage payment is high due to this. After expenses like taxes, insurance, and maintenance, let's say you're paying around $3,100 a month. If the rental income is $2,800 per month, guys, you're losing money every month. And in our eyes, that's not an investment. That's just more money out of your pocket each month. This is why financing isn't just about getting approved. It's about understanding what you can afford and, even more importantly, what types of deals are even possible for you. Let's move on to step 2: choosing the right property type. Now, most beginners are told to start with a single family home. Guys, we don't recommend that. Single family homes usually mean one tenant, one rent payment, one income source. If that tenant leaves, your income instantly goes to zero, but the expenses don't go to zero. It's this degree of risk that we were not willing to take on. Part of our vision with real estate investing is limiting risk, which we speak about in one of our other videos. Let's talk about duplexes. Duplexes are a step up from single family homes. And honestly, they're a great place to start if that's what you can afford. 2 units, 2 rents, less risk if 1 unit is vacant. They're often financed similarly to single family homes, but are much more forgiving. Now, triplexes increase stability even more. 3 rents, better cash flow potential, less dependence on just one tenant. Now, they're harder to find, but usually stronger on paper. Fourplexes take this idea even further. 4 units, 4 income streams, only a 25% decrease in cash flow if a tenant moves out. One vacancy doesn't make nearly as big of an impact as with a duplex or triplex. For working professionals, we believe that stability matters. Absolutely. With commercial properties 5 units and above, I'm sure you can see how things get even sweeter. All right, team, step 3: pick the right market. This step mattered more than anything else for us. We bought our property sight unseen, so the market had to do a lot of the heavy lifting. And here are the things that we focused on. Number 1, landlord-friendly state laws. This was a non-negotiable for us. Some states make it very difficult to operate as a landlord, you guys. Long eviction timelines, strict rent control, unclear rules. We wanted the ability to resolve issues quickly and make key financial decisions. It's important to research each state's rental laws, but some examples of landlord friendly states are Florida, Texas, Montana, and Arizona. In our opinion, landlord friendly states reduce your risk and stress, and that is why we chose to focus on searching in these markets. Number two, gentrification and long term growth. Simply put, gentrification is when neighborhoods are improving. When searching for properties, we weren't chasing hype or fancy A-plus neighborhoods. We looked for areas showing steady improvement, new development, growing infrastructure, areas with potential. It's in these areas that you're likely to get a better price, but with values and rents that are growing over time. We understand that real estate is not a get rich quick game, but rather a long term game. And that's why we chose to buy in a gentrifying neighborhood in a landlord friendly state. Number three, strong rental demand. When searching, we wanted markets where people needed to rent. Notice how I say needed to rent rather than wanted to rent. We're looking at areas with population growth, limited housing supply, and close to urban areas. We wanted an area where we knew people needed to live in order to work. It's that strong rental demand that lowers vacancy risk. That's why we chose an area that was close to a metropolitan city, in a gentrifying neighborhood, in a landlord friendly state. If you need help choosing the right market to buy in, we'd be more than happy to talk with you. You can book a free call with us using the link in the description. All right, back to it. Let's finish with our final step, step 4. Run the numbers properly. This is where everything comes together. This critical step is what separates profitable deals from fantasy deals. It's what separates you as an investor. First, we always determine current rental income. Go ahead and write that figure down. For example, let's say we found a duplex in Texas that brings in $1,500 per unit per month. That's a total monthly rental income of $3,000. Second, let's estimate the expenses. List every expense out. Your mortgage, your property taxes. These can be looked up online as they're usually public record. Your insurance costs, your utility costs that you cover, like garbage and maybe water. Your maintenance costs. I like to estimate $125 per unit per month. Vacancy costs. I usually like to estimate 5%. Property management costs. For our example, let's say the expenses are as follows. Your monthly mortgage is $1,800. Your property taxes are $5,600 yearly. Divided by 12, that's about $467 per month. Your insurance costs, let's say it's $3,500 yearly. Divided by 12, that's about $292 per month. Your utility costs, let's say around $150 per month. Maintenance, from the rule I like to follow, that'll be $125 times 2 units, which is $250 per month. Vacancy, I always like to estimate 5%. So 5% of $3,000 is $150. And property management of 5%, let's say. 5% of $3,000 is $150. If we add all of these up, we're seeing $3,259 per month in expenses. This is greater than the rental income by $259. That being said, this is not a profitable deal. Therefore, I would move on quickly with no emotion. This is an investment. It must make financial sense. So overall, if rent minus expenses is negative, I recommend walking away. But if rent minus expenses is positive, this deal is going to pay for itself and put money back in your pocket each month. It's this type of property that has the potential to be a good investment. With running the numbers, we also need to estimate renovation costs. Renovations should increase your rents. It's important to estimate costs as best as you can. For example, updating kitchens, updating bathrooms, putting in new floors, painting the walls, doing any major system upgrades like a roof, plumbing, or electrical. And after doing this, you ask yourself, how much rent does this realistically add? Go ahead and look at comparable units, comps as we call them, in the same area and what they're renting for in the condition that you're going to renovate yours to. If the new rents justify that additional investment, this might be a deal that you want to dive deeper into. From the example above, let's say $15,000 in renovations will increase your monthly rents to $2,000 per month. Now the monthly rents are $4,000. This could be a good deal. Let me show you what we built to help us with this process. So this is the custom calculator that we built to help us evaluate deals. It's a very plug and play, easy to use calculator that basically prevents all that manual labor that we did just a little bit ago. So with the calculator, we simply just plug in our purchase price. So let's say we have a property we're looking at $750,000. We plug that in at the top. According to our pre-approval, let's say we need to give a 20% down payment. That means the loan amount is 80%. The equity amount then would be $150,000. Our loan amount would be $600,000. Let's say we get a 6.5% interest rate at a 30-year loan at 12 payments per year for 360 total payments. So with that, I'm going to learn that our monthly mortgage payment is going to be $3,792.41. So this is where it gets fun, you guys. Let's plug in our income and expense variables and see what it spits out to us. So let's say our monthly rents for this property are going to be a total of $8,500. I plug that in. Yearly rent increases, I usually just keep that at 1 or 2% depending on the market. And let's say a vacancy rate of 5%. I always assume about 5% per year. Let's now go in and plug in our expenses. Let's say our property tax on this property is going to be $8,000 per year. Let's say that our insurance is going to be $4,500 per year. Let's say our property management company is going to charge us 7% of gross rents per month. Our maintenance costs, let's just call those 3% per year. Utilities at 2%, no HOA and no other fees. So plugging in our total equity invested down here, let's go up to our equity amount. That's going to be $150,000. Let's assume, say, $30,000 in closing costs. That takes us to $180,000. And let's assume renovations of like $40,000. Put that in right here just as a note. That takes us to a total of $220,000. Let's say that this unit supposedly is a triplex. I'd plug in 3. My tax rate, I'm in the 24% tax bracket. Here's for depreciation. We always leave that at 27.5. Any notes you want to put on the property, you can put those down here. Let's go over to the right-hand side, you guys. This is where it gets really, really fun on the calculator. So basically, it takes all the numbers on the left and it starts computing key figures for us. So the key ones are going to be your monthly rents, your expenses, and what it's spitting out down here. Our net operating income is going to be $72,160 per year. After the interest and depreciation, we're looking at after-tax income of $12,611 per year. What I really focus on, though, on our calculator are the orange figures, right? The first one is going to be our after-tax monthly cash flow. And from this example, we would be looking at a monthly cash flow of $1,889. That, to me, is pretty dang good. I'm liking this deal. Our after-tax cash-on-cash return, 10.3%, super good. Cap rate, 9.6%, super good. After-tax return on investment, 13.35%, super good. And the payback period where I get all my money that I invested back at 8.25 years, this deal I would definitely try and pull the trigger on. Now, I know I mentioned a lot of things that I haven't mentioned in this video, such as cap rate, cash-on-cash return, return on investment. These are all things that we teach our students in First Asset Academy. And if you're interested and you want access to this calculator, you want to learn how to use this calculator, go ahead and click the link in the description. We'd love to have a conversation with you. So let's wrap this video up. Here's what all of this really gives you. Not a shortcut, not a guarantee, but a filter that allows you to narrow down the how, the what, the where, and the why. 1, how much you can afford. 2, what size property you should be looking for. 3, where you should focus on searching. And 4, why a particular property makes financial sense. After you understand these 4 steps, you stop chasing every listing you see online. You know how to 1, filter properties based on your price range. 2, isolate only multifamily homes. 3, search in just one area, and 4, run the numbers without guessing. That's what changed things for Haley and I. We're not full-time investors. We don't have some massive portfolio. We're working professionals who learned how to evaluate deals clearly and realistically. And that's the real goal with investing in real estate. Now, I hope this video was helpful. Thanks for watching. Have a great day.